Dan Passarelli here. How are you feeling today? Oh boy, we got a great presentation here for you today. This is going to be an awesome workshop. Before we get started, I want to make sure that you can hear me. If you can hear me, please go to the Q&A box right now, this very second, and give me a big old woo-hoo. Give me one of those, huh? Let me know you can hear me. I want to know you can hear me. I want to know you're excited. Justin, boom. Yes, thank you. Thank you. Mark, thank you, sir. Thank you, thank you, thank you. All right. Steve, yeah. Okay, there we go. I love it. All right, folks, today we're continuing our series in understanding the Greeks. And today we're talking about Vega, navigating market volatility. Now, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Get a copy of that by emailing investor services at theocc.com once again. Now, that being said, don't trade with money you're not prepared to lose. And what we're doing here today is giving generalized information, not advice specific to your situation, because I don't know your situation yet. We're just getting to know each other, even though some of you have gotten to know pretty well because you show up every Tuesday. You're committed, and I love that. All right, now let's make sure that those of you who are not familiar with me, who's maybe it's your first time here, we got any first timers? Let's look over here on my other screen here to see. We got some first timers here. Hey, if you're a first timer here, let me know. Just type in first timer in the questions box. Type in first timer if this is your first time joining us for our Tuesday workshop here. All right. I see some familiar names for sure. I see a lot of familiar names. Got any first timers? First time in a long time, Steve. All right. Well, welcome back, my friend. Welcome back. Kazum, well, welcome. We love first timers. Great job. All right, man. I love it. Okay. So, all that being said, for you first timers, I am Dan Passarelli, and I am an author of two of the most popular option trading books, working on my third, actually. I'm pretty excited about that. My most popular one is called Trading Option Greeks, and that is published by Bloomberg Wiley, forward written by Bill Brodsky, former chairman of the CBOE. And that one is the one that I'm mostly known for, Trading Option Greeks. Been called the Bible of the Greeks, been rated the top 5 option trading books by a good handful of sources. So that is me, but I'm also a trader. That's how I got to be able to write a book. I've been in option trading for over 30 years. Oh my gosh, that's why I got that gray hair. I was wondering about that. I'm also the founder of Market Taker Mentoring, which is the global leader in option trader education. We've trained tens of thousands of option traders, and we have students in over 50 countries. Oh my goodness. And I'm also a trading industry collaborator. I work with many of the top options related firms in the world, including most of the exchanges in the world. I've actually worked in some capacity with options exchanges, that is. And most of the options friendly brokers also in the world, including and especially the really good ones like Firstrade. And outside of trading, I'm a family man. Those of you who are a market taker, student trader, you are probably familiar with my wife, Kathleen, who runs operations here at Market Taker. And I do other things for fun besides trading. I'm a runner, foodie, traveler, and music person as well. Now, for those of you who are very interested in the Greeks, which is all of you, because otherwise you wouldn't be here today, because this month is all on the Greeks every Tuesday. as a prelude to the book, if you just ordered it and you're waiting for it to arrive, you can also check out our quick reference guide on the option Greeks. Just go to markettaker.com/QRG, stands for Quick Reference Guide. And that's it's a very abridged version from the book, of course. But it's a nice little thing to have handy just to be able to reference stuff about the Greeks whenever you need it. So do that. That's free to you. My gift for you for showing up. So let's talk about using Vega to trade. We're going to talk about implied volatility and realized volatility. We're going to talk about Vega. We're going to talk about some basic examples and Vega and some option strategies. So first things first, volatility. So this one here, volatility, is a little tricky. I'm not going to lie to you. Because you know why? Because option traders have two different definitions for volatility. Well, or at least two different concepts that use the word volatility. One is what is called realized volatility. That is the annualized standard deviation of an asset's prices. So, boy, oh boy, that's a mouthful, isn't it? What does that even mean, right? Well, the real definition, the humanized definition, is it's how much the stock has moved around lately, okay? And we're going to look at some examples of how all this works in just a second. Also called historical volatility, statistical volatility, or we could just say the stock volatility, or if we're talking about futures, the futures volatility. So that's the easy one. Implied volatility, well, that's the trickier one. That's the one that it takes, I'm not going to lie to you, it takes people a little bit to wrap their heads around. It really does. So the textbook definition there is it's the volatility figure that when entered into an options pricing model yields a theoretical value reflecting current market prices. Geez Louise, what the heck does that even mean? Well, let's talk about the humanized definition here. It's just how cheap or expensive the options are, all else held constant. We'll talk about that in a second. Now, a lot of people will interpret it as the market's estimation of the future volatility in an asset, a stock. And there's some truth to that, and there's some lies in that. We'll talk about both. So first of all, let's say we've got two different stocks here. So this one bounces around over a range between what is this? About 213 to 260. That's like almost $50 from a $200. I mean, that's like a 25% range. It's bouncing around over a 6-month period. This one has a low of about 105 and a high of about 150. I mean, that's almost a $50 range on a $100 stock. Which one's more volatile? Well, this one is, but you look at these two graphs and it's like, I don't know, they're both like juke, 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 juke. So when you look at a stock chart, when you log into Firstrade and you look at a stock chart, what they want to do is they want to make it as easy for you to read as possible, right? And this is true with any stock charts that you look at. They want to take the lowest price of the range you're looking at, in this case 6 months, and put it near the bottom, and the highest price in that range near the top. So they adjust the y-axis, the vertical axis, okay? So sometimes these can be really compact, and even if it doesn't move a lot, it looks like it whips around. And sometimes if it moves a ton, I mean, if this range went from 400 to 100 and it was the same stock prices, it would look like almost a flat line, right? So the moral to the story is it's really, really difficult to just look at a stock chart and tell how volatile a stock is. So we need an actual mathematical measure of the volatility of a stock. And we do that by looking at the realized volatility. Okay, the realized volatility is what? The realized volatility is when they take the closing prices of the past, X number of days, which is typically a 30-day period, and they find the standard deviation of those closing prices and they annualize it so that they take that 30-day period and they say, well, if every 30-day period was like this in a year, it would be this. And they do it that way for a reason, because what if you're looking at like a 10-day option and a 17-day option and a 24-day option? Well, if you're just looking at the standard deviation for each one of those periods, it's going to be apples and oranges. But if you annualize it, now we got apples to apples. So this is just a backward looking look at the stock volatility. And it looks something, I mean, it doesn't really look like this. It's more this is sort of a cross between a bell curve and a log normal distribution. You're familiar with a bell curve probably, right? I think everybody's learned what a bell curve is at some point. That's just like, this would be basically the stock price, and the vertical axis would be the probability of it being at that stock price. So they'd take the closing prices for that 30-day period. They'd find the mean or average, and they'd put it right here. And then they'd take all the closing prices and they'd plot them out. And what you'd find is you'd find something that looks kind of like this. Technically, it would be a leptokurtotic log normal distribution if we want to get fancy here. But this artist's rendition of a bastardized bell curve / log normal distribution is close enough. But, you know, basically, if they take the closing prices around the mean, it would basically be a shape sort of like this for any given stock at any given time. And then, of course, they annualize it, like I mentioned before. That's why I say, of course, not that it's necessarily intuitive. And they basically plot the standard deviations here. All right. If you're not familiar with standard deviations, honestly, don't worry about it. Just know that that's what it is as trivia. And if you're kind of nerdy like me and you want to dig deep, look stuff up, go to the Wikipedia page. Oh my gosh, there's like more on standard deviation than you would ever want to know. But like I said, if you're a big nerd like me, that's what you could do. So implied volatility, now this is something completely different. Remember on Rocky and Bullwinkle when Rocky would say, now for something completely different? Or was that Bullwinkle that said that? Geez, I forget. I think it was Rocky. Anybody remember? Anybody who used to watch Rocky and Bullwinkle? That was like my favorite show when I was a kid. And no, I was too young to watch it when it was like live, but I used to watch the reruns. There would be Rocky and Bullwinkle. There'd be the Honeymooners. You know, during the day was I Love Lucy. Hey, what's up, Jer? How are you doing, my friend? Yeah, so anyway, no Rocky and Bullwinkle fans here? Okay, never mind. Let's move on. LMO. Let's move on. So implied volatility is, okay, here's that fancy definition again. The volatility figure that when entered into an option pricing model yields a theoretical value reflecting current market prices. Geez Louise, what the heck does that even mean? Well, we'll talk more about that in just a second. And like I said, a lot of people look at that as the volatility implied by option prices, but really, well, we'll talk about that more in a second too. Okay. What if you had a $50 stock and you look at like the December 50 calls and they're trading for $4? You look at a different $50 stock, and their December 50 calls are trading at $2. Now, you might like accidentally observe something like this and not even put any thought into it. But it actually does warrant some thought. What's different about these? Because, I mean, the prices are determined by supply and demand, but there's only so many inputs that logically would go into a pricing decision. There's only so many inputs that affect what I would call the value of the option. So implied volatility is the big difference. So, okay, option pricing models. Give me a yes if you've heard of the Black-Scholes options pricing model. Give me a yes or a no. Have you heard of the Black-Scholes option pricing model? I got a no. I got a yes. That's it. We got a bunch of people in here. I need more answers than this. What are you guys doing? Sleeping on the job over here, man? Let's go. Shane says no. We got a yes. We got a no. Wow, we're almost like right now we're 60% no. Any more? Come on. I'm not trying to like waste my breath over here, man. Okay, now we're pretty close to 50-50. Okay, good. So, oh, this will be great. No, no, no. Oh, okay, we got more no's than okay. So let me tell you something. Options, okay? Those of you who are familiar with options and have a Firstrade account or any broker for that matter, and you look at options. In fact, let's do that for a second. Research tools, options. Whoops, I clicked the wrong button. All right, we'll do it on that. Oh, I was like, yeah, I did click the wrong button. You know, let's look at SPY. Let's keep it general here. Option chain. So here's a bunch of options. I could buy these 561 calls at $1.40. I could sell at $1.39. These are prices. Where do these prices come from? Well, they're all listed on an options exchange. Okay. They're all listed on an options exchange. And that started in 1973. That's when the first options were ever listed on the Chicago Board Options Exchange. But they've been around for a long time before that. In fact, in like, what was it? I want to say it was 1653 to 1656, I want to say, in Holland, the Netherlands. There were some folks who discovered that in Turkey, or what is now Turkey, in some of the wealthier folks' gardens, there was this unique, pretty flower that nobody had ever really seen before. And so some of the Dutch people who, you know, that's back when the Dutch was like, they were the empire of the world, right? You know, we think like before Britain was the big empire of the world, it was the Dutch. And so they went to the Asia Minor Peninsula there, and they're like, huh, cool flowers. We're the Dutch. We're the empire. So we're going to have some of these tulips in our yards, you know, the merchants and the elite, right? And so then it became just a craze. Like you were really super cool if you had tulips. And so they started bidding up the price of these tulips. I know this sounds like a ridiculous story, but this is true. And this is to me, this is very interesting. So like it was all the rage. People were paying absurd prices for tulips. So absurd that at some point they just decided to trade what we would call call options on them. They would create contracts for the right to buy tulip bulbs at a certain price because the price was so volatile and would go up so much. They were trading options on frickin' flowers in the 1650s in the Netherlands. Crazy, right? And there's other historical examples even preceding that where there was option trading. Options have been around for a very, very long time, but they only got listed in 1973. Now, because they were around for a long time, a lot of people put in a lot of effort to try and figure out, how do I value these things? How do I make a smart decision in buying or selling these at a logical price? And a lot of mathematicians and economists did all this work to try and figure out what the value is, and none of them could really put their finger on it. That was until, well, 1973, coincidentally, where Fisher Black of University of Chicago, I want to say, and Myron Scholes, I forget where he was from, maybe University of Chicago, created what was called the Black-Scholes options pricing model. And all the models before then knew, well, obviously the price of the underlying is an input. So is the strike price, the price where the contract allows us to buy, in the case of calls, the underlying. Interest rate intuitively has something to do with it. Dividends didn't really come into play at the time. That wasn't in the Black-Scholes model. Time to expiration obviously matters, right? But there was always this unknown. And so that was the brilliance of the Black-Scholes model, is they put in the unknown as being volatility, with the a priori assumption that traders, investors, anyone buying or selling options made decisions based on their assumptions of future volatility. And there is some logic to that, isn't there? There's definitely some logic to that, right? If I was trading these on Dutch tulip bulbs in the 1650s, where the prices just whipped around like mad, I would probably pay a lot more for those call options, because they could, the bulbs could go up in price. I mean, they went up in price thousands of percent. But if I'm buying a call on some like super boring company that barely ever moves, you know, like AT&T is a pretty not volatile company, right? GM, fairly non-volatile, at least lately. I'm not going to pay a lot for those call options. So the volatility matters. And that was the unknown input that they put into the pricing model. So that was the Black-Scholes model, which was valid only for non-dividend paying European style call options, which is, we've moved beyond that to create other models that account for American style options, dividends, and puts. So that's Black-Scholes model, although there is an assertion by a guy named Edward Thorpe that maybe he might have come up with the model before them. He just didn't publish it in an academic journal and chose instead to use it to trade for himself and not let other people know about. But is that true? I don't know. It's an assertion. That'll be for other people to discover, not me. So volatility is this extra input. And by the way, if I asked you, especially the people who said, no, this is my first exposure to an options pricing model, to tell me, well, what influences go into the price of an option? I mean, you might come up with things like, well, how about earnings announcements? How about Fed announcements? How about, support and resistance? How about all these other things? The answer is no. All that is generalized and accounted for in this. The current price of the underlying, or current underlying price, right? Whatever the current underlying price is right now, they just assume that option prices are log normally distributed. And if there is an earnings announcement, well, that might be a plot that goes on the tails of that log normal distribution. So all this encompasses every other reason that you could think of. Okay. So this is it's a pretty clever thing, really. So when implied volatility rises, so do option prices. When implied volatility falls, so do option prices. So what does that mean? Implied volatility is derived from the market. Really, these first two bullet points, we can look at them the other way around. When option prices rise, implied volatility rises. When option prices fall, implied volatility falls. That's because if I'm trading options and deciding to buy a call for speculation or a put for hedging or a straddle, and I believe that that the stock is going to move a lot more, well, obviously I'm more likely to buy if I think it's going to move a lot more. When the market as a whole believes it might be more volatile, the market as a whole buys, right? When there's demand pressure, that puts the price of anything higher. So the input, and let's go back for a second, the input here that changes when demand bids up the prices is, well, not the stock price, and the strike price always stays the same. And obviously it's not the interest rate or dividends, and time is just linear. It's on the calendar, right? So that's the volatility input. When there's more demand created because there's the assumption that volatility will be high, that's when the implied volatility figure in the options pricing model gets lifted. And when it looks like a more complacent market and it looks like volatility will not be high, that's when that's when selling pressure comes in. People do covered calls and sell credit spreads and iron condors, and implied volatility then gets lowered to account for the lower prices. Now, implied volatility matters in every single option you ever will think about trading ever. But sometimes it's extremely important. Sometimes, it's just a little important. But sometimes it's actually more important than time or directional movement. So, all right. If you have a stock price, stock's at 40, 60 days to expiration, the implied volatility is 30. If implied volatility goes up a point, let's say the price of the 40 strike call goes up by 7 cents. If it goes up another point, it goes up by another 7 cents. If it goes down a point, it's down by 7, down another point, down by 7. Why is that? Well, it's because we can measure exactly how much implied volatility changes the price of the option. Every 1 point that implied volatility changes, the option price changes by what we call Vega. And so we can look in an options chain here. We can pull up Firstrade and we can go to Greek's Analytical. It's just a little toggle switch here. Let me show you that. I'll show you how to get there. If we go to the option section, go to option chain, it'll normally default to calls and puts because this is the main thing we want to look at. But most of the time, we also want to look at the Greeks. So we just go to chain type Greeks/analytical. And then we just click on what expiration we want. And here we can see implied volatility, IV, delta, gamma, rho, theta, and Vega. So that's how we do that. So here the implied volatility is 36.08 on these calls. And the Vega is 0.138854. Okay, we probably don't need all those decimals. What we really care about is maybe the first three. This is 0.138. So we can round that to 0.14. What is 0.14? Well, that's 14 cents of option premium. That means If implied volatility goes up 1 point from 3608 to 3708, the call will increase in value by 14 cents. If this goes down 1 point from 36.08 to 35.08, the option price will go down by 14 cents. And if we look at the put, it's actually the same thing. Here, hold on. Right? The Vega is 13 point, well, it's 0.138854, 0.138854. The implied volatility, particularly for the at the monies and lower strikes, is going to be identical. Once we get into some higher, well, I guess it's identical in the higher strikes too. So the Vega tends to be about the same. All right. So long-term options have higher Vega than short-term options. So what that means is a change in implied volatility for a 120-day option, a 1 point change, will change the value of the option more than a 1 point implied volatility change in a 5-day option. But that's a little bit misleading because the fact of the matter is shorter term options implied volatility changes more. I think of it as like a whip. Remember Indiana Jones? I'm dating myself with all these references. Rocky and Bullwink. I mean, that one's really dating myself, but I'm telling you, I was not alive when that first came out live. Okay. Not that old, but Indiana Jones. Yeah. I was alive when that came out. So you remember like he'd like do the whip. And how does a whip work? Well, the point you're holding it, you just like flick your wrist like this, right? Just like you move it an inch. And the end of the whip goes, right? Really high, really low. That's kind of what it's like with the implied volatility of options. The really long-term ones, that's just the flick of the wrist here, right? That's just a little teeny weeny little move. It changes the option prices a lot because it has a high Vega, but the short-term options, where the skinny part of the whip is, well, the implied volatility really goes up and down a lot there. Although the Vega is smaller, so it changes the options not as much. Still, net effect, the price of options changes a great deal more in the shorter term options. So near the money options have higher Vega than in or out of the money options, which is kind of tricky. Like the first time you really think about that, you're like, wait a minute. So like out of the money options and in the money options have like, they both have small Vegas, but the ones in the middle have the big Vegas. Yeah, that's true. It might seem a little bit weird at first, but that is true. And we talked about that with theta last week. It's the same with, and here's the magic. It's the same with theta, with Vega, and with gamma. All three of those, the at the monies is the highest and in or out of the monies is lower. Delta is the only one where it's, more linear. Okay. All good so far? Yes? Okay, good. So as far as the market mechanics of implied volatility, here's how this looks. Here's what happens. So imagine that you come in here and you're like, okay, well, here, let's get this back to the prices here, calls and puts. You're like, okay, I want to buy some of these calls. And obviously, this is just hypothetical here. I want to buy some of these 540 calls at 450. I'm going to put in my bid to buy 10 of these. Okay. You know what's going to happen? You're going to put in a bid to buy at 450, and there's still going to be more offered at 450. You know why? Because in spiders, there is a massive amount of volume and open interest of size on the bid and the ask, there's a bunch of people trading it. So if you try to buy 10, nobody cares. But if Goldman Sachs comes in to buy 10,000 of these, well, they're not going to be offered at 450 anymore. The market makers are going to sell, and they might not even sell 10,000 at 450. To be fair, the size is shown here. There's 9 on the bid and 94 on the offer. Usually when it's like 9 or something like that, secretly it's more than 9, but probably the market makers, who are the liquidity providers, they might sell like 1,000 at Goldman at 450 and then like 2,000 more at 460 and the rest at, or 451 and the rest at 452, and then raise their implied volatility even more so that their offer is 453. Why? Well, it's supply and demand. Remember supply and demand curves from high school or college? Well, if you're under 40, you probably don't, because they don't teach economics anymore in school. They want you to not understand how money works. So yeah, but they used to. So if you're over 40, you probably were properly educated in how economics works. With supply and demand curves, the more demand there is, it pushes prices up. There's less willingness to supply at a specific price, so it pushes the amount willing to be supplied higher. Which makes sense, right? Like, think about it. Let's say you are selling apples at a at an open market, right? And you have 100 apples. And you're like, oh, I'll sell them for 10 cents each. And you've been doing this for a while. You've been selling them at 10 cents each. You can set the price whatever you want. It's your shop. It's free world, free market. But today, somebody comes in and says, I want to buy 50 of your apples, like half of it, like first person of the day. And then somebody right behind him says, oh, wait, no, I'll buy the other 50. And then somebody's like, wait a minute, I want some too. And you're like, what the heck's going on? And you ask one of the guys and he says, oh, well, today is National Apple Day. And you're like, what the heck's National Apple Day? I don't care what National Apple Day is, but people want to buy my apples. And it wouldn't really be fair if I just give them all to the first person. So what is fair? Well, I'm going to raise the price a little bit because there's more demand. So instead of selling them at 10 cents, you might decide to sell them at 15 cents. And the first guy's like, well, I guess I don't need 50. I'll take 30. And the other guy's like, yeah, okay, I'll just take 10, right? It sort of balances out. It's psychology and human nature, right? It balances out and finds the equilibrium price, right? So that is how everything works when not manipulated, right? But that is implied volatility is the mechanism of that for option prices. Because when the stock goes up, prices change. When time passes, prices change. When the interest rates change, prices change. If we want to isolate that just to the supply and the demand factor, that is implied volatility. That bidding, hey, I want 50 apples. Wait a minute, let me raise my implied volatility here. Okay, instead of 10 cents, it's 15 cents. That's how that works with option prices. So, just like, not to beat a dead horse here, but, oh, wait, hold on a second. Not to beat a dead horse here, but say we have the May 100 call that's trading at a 70 volatility. And by the way, the range of volatility, I mean, it can go from 15 to 200. And it can be below 15 and above 200. That's not an absolute range. I've seen it up at 1,000 and I've seen it down at like 6. If at a 70 implied volatility, maybe the option price is 12.20, say the Vega's 10 cents. Well, if implied goes up to 71, the option price goes up to 12.30 because the Vega is 10 cents, right? 1 point times 10 cents is 10 cents. 2 points times 10 cents is 20 cents, right? And the same thing for going down. Now there's some dynamic inputs here. As moneyness, time, and volatility change, so does Vega. And I know there's some first timers here, but we talked about what all these terms mean in our last two sessions. If you did not see the last two sessions, Firstrade does a great job by recording all these, archiving them, and putting them on their YouTube channel. So this whole month is a series, Understanding the Greeks. So this is one part in a 4-part series. Before next Tuesday at noon Eastern, before next Tuesday, you should go back. If you haven't seen them already, go to Firstrade's YouTube channel and look at the Understanding Greeks on Delta and the Understanding Greeks on Theta, okay? So as far as moneyness, which is how much the underlying stock goes up or down relative to the strike price, as options get more in or out of the money, Vega changes, which is in hindsight intuitive. I won't say obvious, but in hindsight intuitive, because if it's at the money, it's got a higher Vega. If it's in or out of the money, it's got a lower Vega. So when it gets closer or farther from in the money, it gets less or more big. Near the money options have the highest Vega. In the money, out of the money, have a lower Vega. Okay. As time passes, hold on a second. What happened here? As time passes, Vegas decrease. And we talked about that already. And even volatility affects Vega, which is kind of funny, right? An increase in volatility will cause the Vegas of all options to get bigger, and a decrease in volatility causes the Vegas of all options to get smaller. Long call. So long call is generally considered a bullish position, but and because like if you were to buy, well, if you thought an ETF or something was going to go up, you might consider buying a call, right? That's very logical. If you've traded options before, you've probably done this. And what you're mainly thinking about, especially if like you're newer to this, what you're mainly thinking about is, yeah, underlying goes up, calls go up, delta, right? But as we talked about last week, theta comes into play. And as we're talking about this week, Vega and volatility comes into play. There is implied volatility risk. So let's say on this stock, we think it's going up for whatever reason in this hypothetical example, and we buy the 242.5 calls at $16.95. The Vega is about 15 cents, around that. And implied volatility is 87.32. Okay. So what does that mean? Let's take a look here. 242.5 calls. Okay. Here's the thing. With most stocks and ETFs, not all of them, but most, when the stock goes higher, implied volatility tends to go down. And when the stock goes lower, well, implied volatility tends to go up. Well, first of all, let's talk about that. Why is that? Well, because implied volatility is a function of, well, it's really a function of one thing, supply and demand, but it's thought to be a function of volatility. When stocks go, well, let's start out with the down case. When stocks go down, that's when people get scared. There's more fear to the downside. Why? Well, because unlike options, stocks exist in the wild. When there's an IPO, the company has created shares of stock. They're actually created technically before then, but they're publicly traded after that. But they exist. They are a right, a stake holding in that company. Whereas an option is a contract that's created once it's traded. And so somebody owns those shares. And when they go down, somebody's losing money. And it's a lot of somebody's. And so there's more fear of that volatility to the downside. That's when people start buying puts to protect themselves or straddles to try and make money on volatility, or calls to play the rebound. When stocks go up, the fear's not really there. People are like, yeah, woohoo, I'm making money. Hey, I'm going to make even more money by selling covered calls. And they sell options and implied volatility goes down. So we've got this volatility risk where even if we make money on direction, the delta, with most stocks, we're going to lose a little bit on implied volatility. And of course, like we talked about last week, as time passes, we'll lose on time passing too. So we always want to make the best decision we can about which particular call we buy. So, and this leads into Asim's question here. How do you find out which strike is the best value to buy? So very great question, Asim, and very timely. What we want to do is we want to look at the implied volatility and the Vega. And probably what we do is we would look at the implied volatility of different strikes. Oh, here I can buy a 5-point lower implied volatility. And I might look at different expirations and choose the one that's cheaper. Now, when I say that, volatility is just one factor that goes into this decision. Our delta is going to matter, our theta is going to matter, and we're going to talk about all that next week. So, as usual, good question, Aslam. So we're going to profit or lose from delta and theta, but we're also going to profit or lose from IV changing, meaning Vega. So we're going to look at the price. We're going to look at the Greeks. And for what we're talking about today, we're going to look at implied volatility and Vega. And we're going to need to ascertain, is implied volatility high or is it low? Is it cheap or is it expensive? And we have talked about that in previous classes, workshops here on Firstrade. Again, I direct you to the YouTube channel, or you can always email me, dan@markettaker.com, and I can direct you to them as well. dan@markettaker.com, 2 T's in a row. So, implication, we always need to analyze volatility to determine whether it's cheap or expensive, because that helps us decide which particular options to buy or sell, or even whether we should be buying or selling. If I think a stock's going up, I could buy a call, I could buy an in the money, I could buy an at the money, out of the money. But if implied volatility is high, I might hedge it by buying a call spread. If implied volatility is really high, I might, and I'm not worried about downside risk, I might sell a put or a put spread to take advantage of direction, delta, and theta, time, and Vega, implied volatility. Also, there's an additive quality of Vega. So, yeah, we've got a lot of decimals here. We'll just use the first 2 decimal places. So 15 cents. If the Vega of one of these calls is 15 cents, so the Vega of 2 of these calls is going to be 30 cents. The Vega of 10 of them is going to be $1.50. Vega of 100 is going to be 15 bucks. Let's talk about a straddle here. So a straddle is a pure volatility strategy. And we often think about it in terms of a P&L diagram, profit and loss diagram, which I show those in most of our presentations here. It can also be a gamma strategy, but it sure is a Vega strategy. This is, and if you're not familiar with these, this is when I buy both a call and a put. So like here I buy one of these calls at 90 cents and one of these puts at 95 cents. Same stock, same expiration, same strike. So the thing is how can I lose? Well, I lose money as time passes because I'm buying two options, but I also make or lose based on Vega. So I'm going to profit or lose from the stock going up or down, because there's a P&L diagram that kind of looks like a V. If it goes down a lot, I win because the put increases in value exponentially, where the call can only lose so much. If it goes up a lot, I win because the call increases in value exponentially and I can only lose so much on the put. But the Vega kind of matters too. So the implied volatility here of 91.83, which is the same for both the call and the put. Well, is that cheap or expensive? How do we know? Well, we need to compare implied volatility levels on the same underlying. How does the current level of implied volatility, so what was that, 91.83 or something, compare to what it used to be, maybe over a 6-month period or a 1-year time frame? I like to use volatility charts for that. And you can just Google volatility charts and you can get that from a lot of different online sources, probably for free. I recommend not paying for it. I'm sure it's out there somewhere for free. So is today's implied volatility above or below the average? We can't compare implied volatility levels for different underlyings. That's just apples to dump trucks. So that's one thing we want to do, is be good at analyzing volatility. And again, I have talked about that in a previous Firstrade workshop. Check out YouTube. So Vega and option strategies. When we spread, the Vega nets out. We use spreads to minimize Vega risk. So, and I just mentioned that a second ago. Let's say we want a short-term bullish position on this stock. The Vega is kind of high here. Look, so like here's the price, here's the Vega. The Vega is 10 cents. The option price is $5. I mean, that's not 3%. That's more than 3%, right? Hold on a second. I should be able to do this in my head. I used to be able to do these kind of things in my head. Oh, it's 2 cents. It's about 2 cents, I guess. Vega's about 3%. It's about 2%, not 3% of option value. So we want to minimize the volatility in here. Let me just change that. We want to minimize the volatility risk, right? Because I don't want to have 2% that I might make or lose money on just as like dangling in the wind, like could be good, could be bad. I don't want that. So what I might do, instead of just buying this and having that risk, I might do something like a bull call spread, where I buy these at 5.15 and still have, and I'm still getting long 10 cents of Vega, but I sell these at 3.65 and now I'm getting short 10 cents of Vega. Now I have no Vega risk. So basically, if I'm long 10 cents of Vega, if implied volatility goes down, I lose 10 cents. But when I'm short 10 cents of Vega, when implied volatility goes down, I make 10 cents. So it's a natural Vega hedge. So that's what happens when I spread. And it's a way to minimize my volatility risk and retain wanted directional exposure. So this is really useful, if you trade directionally around earnings, if you have some reason for doing that. or takeover rumors. This is a great way to hedge off that super high implied volatility that you see during those events. Or like credit spreads too, right? Credit spreads, like typically I want to sell credit spreads when implied volatility is high, but I don't love a lot of extra wild card, what I would call risk, where I can make or lose on implied volatility changing in the short run. So like a really nice thing about that is I'm selling these, or let's see, I'm selling these puts for 236, buying these puts at 152. Obviously, I'd probably try and middle the market on this to get a better price. But like my Vega, I'm getting short 11 cents of Vega. I mean, if the stock goes down, remember, implied volatility tends to go up, which would be bad for the option that I'm short. So the credit put spread allows me to hedge off some of that volatility risk. So I'm short 11 cents. Here I'm long about 9 cents. So I end up really short only about 2 cents of Vega. So the implied volatility moving doesn't really hurt me that much at all. So it's a little extra analysis, but that's okay. I analyze the volatility, helps me protect myself better, arguably make more money, lose less money, put on smarter trades. I can profit from time passing as I would want to with this. And the stock not going down, which is kind of the bet that I'm making with put credit spreads. And I'm still short Vega, but not that short Vega. All right, what questions do you have before we call it a day here, friends? What questions do you have before we call it a day here, my friends? Any questions? Because next week, ladies and gentlemen, next week, we're taking everything we talked about in the last two classes and we're putting it all in a big cauldron and mixing it around, right? Mixing it around to see how the Greeks all combine to make a delicious trading dish. Aslam says, today's webinar is very interesting and informative. Thank you. You are welcome, my friend. That is what I hope to do. Make it interesting, informative, maybe even a little fun, but especially to make you a better trader. That being said, folks, I will see you next week. Trade smart and have a great week until I see you next Tuesday. Mark your calendars. Bye.